What's going on, guys? Welcome back to another video. In this video, I've got another AMC update to bring all of you this afternoon. So what we're going to be covering in this video is the fact that our financial markets at the current time are teetering. So what I mean by that, it's like we're standing on the edge of a cliff, and one thing could be the straw that breaks the camel's back to send us on a crash or a correction that could be larger than what we saw back in 2008. And I personally believe, with all of these signs and signals that we are seeing out of the market right now, that AMC and GameStop, those short squeezes, could be the straw that breaks the camel's back. Now, in the past, we've been talking about reverse repos to kind of give us an understanding of the state of our markets, but we also have a new indicator, the 10-year Treasury Yield, that is telling us a lot about investor sentiment in our markets at the current time. Now, we're going to go over all of this in detail in this video to make sure that everybody fully understands exactly how important all of these broader economic factors are to our current trades and positions in AMC. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So right now, at the current time that I'm recording, AMC is down a little bit over 8%. This is obviously not what we want to see about our favorite movie theater company, but here are a couple of things that I want to make very clear to you guys. It is going to happen. We are going to see these drops, these rip ups, and that is something that you need to be prepared for. But what we also have to keep in mind is that there has not been any bad news coming out from AMC. It's actually been the opposite. So we know that AMC has continuously been on the threshold list. Now, there's a lot of debate on how important this is, but a key takeaway from this is it's not a bad thing for AMC to actually be on this list. It's either a neutral thing or a good thing, in my opinion. Second, Adam Aron has come out and said no vote on that 25 million shares that he wants to be able to basically issue onto the open market to raise more cash for AMC. That is great for us as AMC investors because we know that we are not going to see any further dilution. The third thing that we have is Black Widow. And this weekend, we're also going to see the Conor McGregor-Dustin Poirier fight happening in AMC theaters. So this weekend could be a decent fundamental catalyst to send us going higher next week for AMC. So there are a lot of good things happening, and the short hedge funds are continuously doing everything they can to push the share price of AMC down. We are also seeing these shorts lose a crazy amount of money. Now, when we come over to Ortex, at the current time that I'm recording, the short interest has gone up about 4% on the day, and we are really close to having a short interest of almost 19%. So obviously, these shorts are still coming out and trying to push the share price of AMC down. So when you think about this logically, a lot of people are in AMC right now for the possibility of a mother of all short squeezes, or an infinity squeeze, as we like to call it. It would not make any logical sense when you're thinking about this position to get worried about selling or liquidating your position if the shorts just added more to their position. They're just digging a deeper hole for themselves. But again, nothing I say in these videos is financial advice. These are for educational and entertainment purposes only. Now, moving on over here, GameStop short sellers lose close to $744 million, and AMC bears lose $2.8 billion in June. Now, GameStop short sellers actually closed $744 million. Sorry for that mistake there, but we can see AMC bears lost $2.8 million in June. 2.8 billion. So that is pretty embarrassing. We are obviously winning in this situation, and they are doing everything they can to push the share price of the stock down. Now, in my opinion, I do think a lot of these over-leveraged funds are trying to find a way to stay in business. I've said this a couple of times, but some of these super over-leveraged institutions or hedge funds that are short on AMC, if they go out of business, it's going to be really hard for them to continue to have a job because they can't go to their previous investors investors and say, hey, well, I know we lost you $30 million in our previous fund, but trust us, we won't do this again. Now, let's get into this AMC crashing the market situation. And again, I say this in a lot of my videos where I talk about this. It's not AMC, the movie theater company, that is going to be the reason why our markets crash. It is the fact that the institutions, the hedge funds, have over-leveraged themselves, engaged in a lot of manipulative tactics, and retail investors decided to take the other side of this trade because they saw value in AMC. So here's what we're looking at here. The US 10-year Treasury, this is widely considered a risk-free investment. Now, we can see that this rate is currently at 1.315%, but looking at this chart, this rate has pretty substantially decreased over the past couple of months. And one of the main reasons why I believe that AMC in this whole situation with the short squeezes is actually going to be one of the things that participates in the crash of our markets is think about how margin accounts work in over leveraging. When you have a portfolio of stock, and you become over leveraged and you are forced out of your position in a short, let's just say it's AMC, you have to sell off your other positions most likely in order to cover that. And a lot of these big funds own very large positions in the blue chips and the different ETFs. So if they have to sell those, that is going to bring a lot of selling pressure into our markets. Now, looking at the 10-year Treasury and the 10-year Treasury yields, it's a really good indicator as to where big money is flowing, but we're going to get into that in a couple of minutes. Now, when we come over to this article right here, the 10-year Treasury yield fell to its lowest level since February on Tuesday amid signs that the economic recovery from the pandemic could be slowing. Now, we've seen comments from the Fed over the past year that has essentially said everything is fine. But when you look at the 10-year Treasury yield and the reverse repos, which we're also going to bring up again, that tells a completely different story. Now, how exactly are we going to track what is exactly going on with the Treasury yield? So here's a great article on Investopedia. What economic factors impact Treasury yields? The most important thing that we need to take a look at is right here. So investors who are wary about the economy might step back a bit from riskier investments, i.e. equities, which are stocks, and instead pile into government-backed securities, which pushes the prices of the bonds higher and the yields of these bonds lower. So we are seeing that happen right now with the yields on these bonds start to decrease. So this suggests that a lot of big money is very worried about something happening in our markets in the near future, which is exactly what I have been saying over the past couple of weeks. We are just receiving more evidence about this. And once we end up seeing these forced liquidations of all of these over leveraged funds, which we're going to get into exactly how we can see that a little bit later, it's going to be most likely a crash is going to occur on a larger scale than 2008. Now, we can basically tell how over leveraged everyone is at the current time because of the fact that our margin debt right now is at about $850 billion. And in 2008, it was in the $400 to $500 billion range. So this is a really good indicator that we need to keep a look at. And if this continues to go down, it is really going to tell us a lot about the overall sentiment in our financial markets. Now, let's come over and take a look at the reverse repos. We recently got a new update. Wednesday, July 7th, we can see that the participating counterparties 65. Yesterday, the participating counterparties was 66. Now, the counterparties are just the different institutions who are participating in the reverse repo market. Now, we've explained this a lot, but I do think that reverse repos are incredibly important in essentially determining what the overall state of our financial markets and our banking system is. And I do want to keep bringing this up so everybody fully understands. So what a reverse repo is the Fed is giving treasuries to the banks and the banks are paying for them with cash. The reason for this is that the banks have too much cash on their balance sheet, and the fact that they have to pay interest on this cash means that having so much cash at a certain point, it then becomes a liability on their balance sheet. So they need to have a place to basically get rid of the cash. And we can see that the reverse repos are kind of consolidating in the $700, $800 billion range. So Eventually, the Fed is not going to keep up this reverse repo program. It's a reverse repurchase agreement where the Fed is selling these securities to the banks in an agreement that they are going to purchase them back later at a higher price. So eventually, the Fed is going to say, hey, enough of this. But we know that the banks still have too much cash. And a lot of these hedge funds are trading at the prime brokerage operations at these banks. Now, what happens when you're over leveraged on a position? The hedge funds have to deposit more collateral in the form of cash into these accounts. And we know that the banks do not want that cash. So there is going to come a point where it may not even matter if the over-leveraged funds can keep getting that liquidity and getting all of this cash and depositing it to all of these banks. The banks might just say, enough is enough. We are going to de-lever a lot of our customers. And that is going to be when those forced share recalls end up coming. In addition to this, we all know that the Fed minutes came out today. And what I've been saying over the past couple of weeks is that it's not necessarily that you can't trust the Fed, but they can't just come out and say everything is screwed. Our banking system is overcooked. We really can't do anything about this, and everything is going to crash. They cannot say that. So what they're going to do is they're going to give us these clues in their minutes. So we know that in the most recent bank stress test that they used data from last October. Now, that doesn't make a lot of sense to figure out basically what would happen to the banks in a time of a market disruptive event if you're using data from over 6 months ago. So we need to take a look at this from a broader perspective and look at the indicators that we can actually see and not take at face value what the FOMC chairs and the committees are actually saying to us. So that is going to conclude this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day and were able to maybe buy the dip if you wanted to, and I'll see you guys in the next video.